Hello everyone, and thank you very much for joining our webinar. We'll wait a little bit for others to join before we start, but in the meantime, you can scan the QR code on screen to download our latest report, Oil Companies in Disguise, which forms the basis for today's discussion. Okay, we can start now. So once again, thank you for joining and welcome to our Oil Companies in Disguise, our Investors Mispricing Automotive Climate Risk webinar, where we'll explore that several automakers may be as carbon intensive as traditional oil and gas companies, and what are the relevant implications for investors. My name is Marina Piligu, and I am Engagement Officer here at Carbon Tracker. For those who may not know us, Carbon Tracker is an independent financial think tank within the Tracker Group that delivers world-leading research to align global finance with climate goals, empowering investors, policymakers, and companies to make informed decisions. Our work is all free to access and download from our website, as well as the usual third-party investor platforms. Today's session will run for 45 minutes. We'll begin with a short presentation of key findings from the latest report. You can again use the QR code to download it. We'll also cover key takeaways for investors, and we'll then move into a panel discussion where we'll answer your own questions as well. So to submit a question, please use the Q&A function, and please include your name as well so our team can follow up if needed. So presenting with us today is Ben Scott, author of the report and head of energy demand at Carbon Tracker, who brings extensive experience in the automotive sector and financial analysis. Ben will also moderate the panel discussion, which will be joined by Harry Penham, who is an energy industry professional with over 30 years international experience in the oil and gas industry with BP and Shell's upstream projects, and several years working in an advisory capacity with EY Oil and Gas in the UK. He now works mainly in energy transition roles, and he is strategic advisor at Carbon Tracker. Ben Yuriev is also joining the panel. He is the director of LobbyMap research on energy, mining, and transport, where he leads the global research, analyzing corporate advocacy on climate regulations. He has extensive experience on climate change at the UNFCCC and multiple think tanks in London. And we also have with us Joseph Jacobelli, managing partner at Born Impact Capital, a single family office, and he is also founder of ACT-E, a not-for-profit climate finance and business insights platform. Joseph has 35 years of banking and executive experience across Europe and Asia. He wrote 2 books at the energy transition and hosts the Asia Climate Finance podcast. So I'll hand over to Ben to begin the presentation.
Thank you very much, Marina, and good to speak to you all today. Today we're going to be discussing a structural risk in automotive portfolios that is fundamentally ignored by mainstream carbon risk modeling. The core thesis for investors is quite simple. When you buy an automotive company, you're not buying a simple capital goods or technology play. You are, in fact, taking on a material long-term exposure to global oil demand and sovereign scale carbon liability. Over the next 10 to 15 minutes, I'll discuss the key findings of our report, Oil Companies in Disguise 2026, where we'll break down the mechanics of what we call the carbon gap, show how current disclosure frameworks mask this exposure, and look at the divergence between electrification strategies that are creating structural winners and laggards. Afterwards, we'll open up a panel session, so please do put your questions into the Q&A box on your screen, and we'll look to answer those. Next slide, please. So I think first, let's align on the core problem. Automakers are structural drivers of global fuel consumption, and there is a flawed narrative in the markets that passenger transport oil demand is an independent consumer choice. Our analysis shows it is a direct consequence of upstream design and capital allocation decisions. When an automaker builds and sells an internal combustion engine or hybrid vehicle, they are locking in 10 to 20 years of future oil demand with zero fuel substitution potential. And why does this matter so much? So if we do one click, please, as we can see on the first charts, road transport is the backbone of global oil demand, with passenger vehicles accounting for around 27% of total global oil consumption. And while technological economics and policy targets anchor long-term electrification, near-term capital allocation shapes the velocity of oil demand destruction. One click, please. We project that a standard transition to 50% global battery electric vehicle sales share by 2035 will destroy around 14 million barrels of oil demand per day. The structural risk for investors is that some automakers are actively slowing battery electric vehicle rollouts, preserving the legacy internal combustion engine and hybrid system, and artificially extending transition vulnerabilities. Next slide, please. And this brings us to our primary findings from the report, the 33% median carbon gap. Across 17 global automakers representing about 80% of global light vehicle sales, the delta between officially reported Scope 3 Category 11 emissions and our calculated real-world emissions is roughly one-third. And this is not a minor auditing nuance. It means that the standard risk assessments being used by institutional investors to evaluate transition readiness are structurally understating emissions. And this distortion translates directly into mispriced transition liability and overvalued assets. Next slide, please. So how is this underreporting happening under existing compliance frameworks? Well, companies have three main areas of flexibility in their approach. The first is lifetime mileage caps. So many automakers apply an arbitrary flat cap, also a flat rate cap, for example, anywhere between 150 and 200,000 kilometers to their entire fleet. And this fails to account for actual road life expectancy and also regional differences. And this is drastically shortening the carbon emitting life of the vehicle on paper. Second, we have the plug-in hybrid myth. So testing cycles like WLTP assume extremely high electric only usage factors. Real world physical data shows that plug-in hybrids operate on their gasoline engines most of the time, emitting up to 5 times their laboratory ratings. And this is backed up by numerous other studies. And third, we have boundary exclusion. So over 20% of emissions associated with driving are generated before the fuel ever hits the tank, so during extraction and refining. Excluding this well to tank boundary truncates the true emissions profile. Next slide, please. So the bubble chart shown here is a distribution of 17 global automakers. These are the ones we analyzed in the report using 2024 data, which is the latest data available for analysis. And just to explain the chart briefly, that the y-axis is the carbon gap. So this is the delta between officially reported Scope 3 Category 11 emissions and our calculated real-world emissions. The x-axis is lifetime emissions per vehicle, and the size of each bubble is proportional to 2024 total annual emissions. And the first thing to say here is that no manufacturer performs very well in our analysis. Automakers should be aiming towards the bottom left of the graph, so a low carbon gap and low lifetime emissions per vehicle. And again, just to reiterate that across the industry, we're seeing underreporting of emissions by about 33% on average. I'm not going to talk about every single automaker here, but Toyota sits at around the industry median mark. But because of Toyota's scale, being the largest automaker in the world, its absolute carbon gap is quite substantial. And we'll talk more about Toyota and hybridization a little bit later. Next slide, please. So coming on to the main thesis of the report, when we normalize these emissions using the tons of CO2 equivalent per $1 million of enterprise value, including cash metric, the sector's true transition risk profile is exposed. So as this chart shows that the median automaker's adjusted carbon intensity is 3.2, and this is higher than traditional oil majors like ExxonMobil at 1.4, BP at 1.9, and Chevron at 2.1, and actually closely trails Shell at 4.0. And a similar trend occurs when analyzed on a carbon to revenue basis. And this completely upends, standard sector classifications. Legacy automotive is not a safe, low emissions asset class. It carries identical transition risks to traditional oil and gas. Next slide, please. So we are witnessing a profound divergence in automaker strategies. On one side, we have the transition leaders focusing capital allocation on dedicated battery-first electric platforms. These firms, such as BYD and BMW to an extent, are structurally eliminating long-term oil exposure and lowering their lifetime carbon intensity. On the other side, we have the legacy laggards who are slowing battery electric vehicle rollouts and relying on hybrid technologies as an incremental hedge. And while this strategy avoids immediate capital write-downs, which we've seen recently, it tethers the company's valuation to terminal internal combustion engine architecture and leaves them highly exposed to tightening compliance mandates. Next slide, please. So let's dismantle the hybrid hedge narrative. Adding a tiny battery to a standard gasoline engine does not represent a deep decarbonisation path. As we show in this report, Toyota's 2024 hybrid fleet emissions alone exceed the combined emissions of entire automakers like BMW. Furthermore, there is a fundamental difference in hybrid architecture. Pure play battery electric vehicle developers like BYD construct hybrids around advanced electric first drivetrains, which achieve significantly higher operational efficiency. In contrast, legacy manufacturers often use ICE bolt-ons as an incremental hedge, leading to a much higher carbon footprint per vehicle. And another interesting point here is that if internal combustion engine vehicles were excluded from its reporting, Toyota's hybrid segment would still rank as the seventh largest emitter globally. So is Toyota making progress to bring battery electric vehicles to market? While hybridization remains central to Toyota's strategy, the automaker has seen an increase in battery electric vehicle sales through 2025 and also year to date 2026, albeit from a low baseline. And it's worth noting that while this report relies on 2024 data and is inherently backward looking, Toyota's current challenge lies in transitioning from ambition to implementation. Given its history to downwardly revise battery electric vehicle sales targets, the company must now demonstrate it can deploy these vehicles at scale. However, Toyota's cautious approach has yielded some strategic advantages against the broader market backdrop of significant battery electric vehicle related write-downs by competitors like Honda and Stellantis. Toyota has successfully avoided these balance sheet shocks. And consequently, while Toyota is steadily progressing from a slow start, peers like Honda appear to be regressing from an equally sluggish baseline. Next slide, please. And finally, we must monitor the corporate emissions accounting debate as well. One click, please. So the greenhouse gas protocol is the standard for carbon accounting and gives investors a comprehensive view of corporate climate risk across the entire value chain for many different industries. And by design, it requires automakers to report Scope 3 Category 11 emissions, so i.e. the lifetime vehicle tailpipe use. And this ensures that corporate design decisions and fossil fuel reliance remain visible to asset managers. One click, please. However, there is a growing industry coalition called Carbon Measures, backed by oil majors and recently joined by Toyota. And it's what Carbon Measures is doing is it's advocating for a transition away from the greenhouse gas protocol towards e-ledgers and e-liabilities. From an investor's perspective, this framework narrows corporate accountability by shifting downstream vehicle emissions off the automaker's balance sheet, masking financial exposure to oil demand without changing real world fuel consumption. Next slide, please. So this is my last slide actually. For an investor, we believe there are six things that should be done to understand automaker transition, and those six things can be brought up on the screen now. But first, we think that automate investors should assess the assumptions underpinning Scope 3 Category 11 disclosures. Reported emissions are only as robust as those inputs. Uh, we should also prioritize verifiable battery electric vehicle sales share targets and delivery over long-term pledges. One click, please. This is the most transparent and comparable indicator of real transition progress. Third, we should benchmark OEM reported emissions against standardized or third-party estimates to identify discrepancies that may signal hidden carbon liabilities. Number four, we should differentiate between OEMs who are investing in dedicated battery electric vehicle platforms and those who are extending internal combustion engine vehicle life cycles via hybrids. The latter risks technological obsolescence and stranded assets. Number five, we should integrate tons of CO2 equivalent per $1 million of enterprise value, including cash or equivalent metrics, into financial analysis to capture transition risk more accurately and avoid mispricing high emission business models. And lastly, we should monitor OEM engagement with alternative emissions reporting frameworks, i.e., e-ledger approaches, as this may signal attempts to reshape accountability rather than reduce those real world emissions. So that concludes my presentation. I hope you found that interesting. I'd now like to open up the panel now, and I'd like the panelists to come forward, Harry, Ben, and Joseph, for a discussion. And as a reminder to the audience as well, if you do have questions around the report or anything related to the electric vehicle transition, then please do put those into the Q&A box on your screen. So, if I may, I'd like to start with you, Ben. To what extent do you think are the OEMs with the largest carbon gap in this report also the ones most actively lobbying against ambitious EV regulations?
I think there's a fairly clear correlation between lots of the OEMs referenced with the largest carbon gap, for example, Toyota, and lots of those OEMs in Japan in particular, and those companies with some of the most negative advocacy on EV regulations globally that we've found in our research. So, in particular, we've found a persistent link between companies with some of the weakest internal battery electric vehicle strategies and those with the most negative climate policy engagement on autos. And that tends to be lots of Japanese automakers who are far behind on the transition and are instead lobbying policymakers globally to slow down regulations to speed it up.
Thank you. And for investors trying to assess which automakers are genuinely committed to the transition, how useful is is lobbying and policy engagement data as a signal alongside the emissions data presented in this report?
I think that lobbying data itself can be one of the best proxies available for investors to understand how internally committed automakers are in the real world compared to sort of the public statements they might make on EVs and on the transition. So, for example, if an automaker is strongly supportive of supplier side regulations for the sector in the key regions that they operate, it strongly suggests an alignment between their internal strategy on electric vehicles and their external advocacy strategies. And I think in particular, a great example of this currently is Volvo Cars, where they have a strong commitment to produce more battery electric vehicles in the near term and have publicly committed to lots of climate policies in the major regions they operate, such as in the EU, where they've been actively pushing for a strong CO2 standard. I think it's 100% by 2035 before that was weakened.
Thanks, Ben. Harry, I'd like to bring you into the conversation. So in my presentation, I talked a lot about Toyota,
Hmm.
and Toyota is actively defending its what they call a multi-pathway hybrid strategy and has avoided some of the immediate battery electric vehicle write-downs that peers like Stellantis or Honda have suffered. So, in your opinion, is the hybrid strategy a genuinely savvy financial hedge, or is it just deferring a larger inevitable capital write-down in the future?
So the short answer is the latter. But the longer answer, I think, is an important one because I think it threads together a lot of the what's in the presentation, what Ben's just said as well. I think what you're seeing now, we're moving as the transition is becoming palpable, seeable, observable. We're moving away from reporting and pledges, if you like, and accounting assumptions into observable outcomes. Like you mentioned, BEV sales as a percentage of your total sales is not a very gameable metric. It's either trending upwards or it's not. I think with hybrids and Toyota especially and Japan Inc. and a few others, they've been promoting it on the belief that I guess the public at large, consumers will assume that on a scale of 1 to 10, if 1 is fully electric, BEV, and 10 is fully ICE, basically a petrol or diesel car, hybrids are something like 4 or 5. And that's a very easy assumption to get over if you throw all your effort not at batteries but at marketing. And so I think what you get, but the real answer is probably something like, as you've said, Ben, from the real world measurement protocols, and we'll get back to that later. I think it's probably closer to an 8.5 or a 9.5 on that scale. So you're effectively ICE with your gasoline car has a lead acid battery, and then your the ICE car which is a hybrid has got another little electric battery on top of that. But that's it quacks like an ICE car and waddles like an ICE car, so it is. And so I think, but coming back to the investment angle, the danger that Toyota and its ilk are running is sort of telling investors, well, if you plunge in too soon, look at Stellantis. Stellantis lost 20 billion last year from doing a sort of a major amount of effort into EVs, which didn't work. And they're saying, well, there you go, the transition's not working. Avoiding things like BYD, who are now the dominant player. What's happened is Stellantis made a very poor attempt at transition, but that's because the transition is necessary. So it's becoming an unavoidable. So they might be right for, say, 3 or 4 or 5 years. They might avoid a write down. They might be able to keep dominating the market segment, which they have in the ICE market, if you like, and this sort of and the small truck market. But what's their strategy for 15 years? The investors should be asking, and 10 to 15 years, because if they're not investing in that future, the destination is clear. It's going to head that way. If they're trying to be reluctant, as Ben was saying, with lobbying and gaming accounting standards and doubling down on marketing for ICE vehicles, then eventually that runs out of road. And so they might be all they're doing is deferring the Stellantis moment rather than avoiding it because they're not putting that effort into genuinely trying to transform. And the final point on this was one you, I think, made during your talk. one of the ways you can, sort of scratch away at that issue is to say what is the real world emissions that are occurring in your company versus what does the laboratory tests in your favour say, and that would give you an insight into two things. One is the transition risk exposure, which is coming up again and again in this presentation, but also the culture and the strategic culture that's saying we're going to try and resist this to the last moment, because we're going to game the system as fast as we can, and not invest and try to lobby against the change. That's a very risky strategy if you're an investor, I would have thought.
Thanks, Harry. And maybe just picking up on one of those earlier points you made, and I'd like to bring Joseph in to answer
Okay.
this. We found in the report that several of the Asian automakers have carbon intensity levels quite similar to oil and gas majors. So in your experience across capital markets, are financial institutions pricing this risk appropriately or even at all?
Um, no, but to be fair, it's very, very difficult to assess, especially once you get into kind of like the scope 3 territory. And what I mean by that is internal combustion engine cars have incredibly complex supply chains. Um, I think, if you're looking just at the internal combustion drivetrain, talking about over 2,000 parts compared to just 20 for an electric vehicle. So for an investor to really dig into it. So what we do, we're long only, right? So we kind of like pick a couple of stocks and really dive into it, perhaps too much, but we dive into it a lot. And then we found that we kind of get lost when it comes to internal combustion engine vehicles because of the supply chains and the low visibility. So all we can do is rely on the reporting, which is not great, but that's what we've got, and B, interview with the management of the companies where, if we're lucky, we get a little bit more information, but still not the level of information that we would like. So the short answer to your question is no, I don't think that it's fully factored in, and partly because of the nature of the animal, because of the supply chains.
Thanks, Joseph. And maybe just building on that as well. You said that there needs to be kind of better reporting or more accurate reporting. How does the concept of a carbon gap factor in? How does that help you in your investment decision making, if at all?
Or I mean, enormously. I mean, we're impact investors. I mean, although we're a single family office, but we absolutely have to look at that. But I've got the luxury of basically saying, well, I don't have to be in that sector, so I can just decide to avoid it. Now, I think there's three areas that globally investors are looking at right now, which is AI, energy, and defense. And guess what? All of these have got automotive angles. So the short answer to the question is, absolutely, it is something that we want to look at, we'd like to consider. Yeah, not sure if that answers your questions, Ben.
No, it does. No, thank you, Joseph. And I'd actually like to come back to Harry with another question, again about the carbon gap. So
Mm.
we uncovered in our report that the industry average, the industry median was a 33% sort of underreporting. But then there are also outliers within that. So Subaru and GM, they exceed sort of 85% and 200% in terms of their carbon gap. So given that these companies are, they're still complying with current greenhouse gas protocol guidelines, does this reveal a sort of fundamental flaw in the flexibility of Scope 3 frameworks? And how should standard setters look to address that?
Yeah, I mean, no, I mean, I think the green. Just looking at your slides there, the greenhouse gas protocol looks a lot better than the alternative being proposed. No, I don't think. I don't think it's broken. I think it just needs to evolve. I think the problem that this report has been really good, and I would say that Carbon Tracker, but it's a really nice capture is to say it's not about compliance to one extent. Maybe everybody can be compliant, but you can't be comparable. Look at that 2 by 2 chart, which shows everybody's comparable and everybody's all over the chart. And so what's happening is everybody's choosing their own assumptions. Let's call it the protocol 1.0 brought in these variables you could use, such as miles traveled and the etc. And then the assumptions about actual emission standards in there. So the problem has been that people can then massage, let's say, the assumptions that they make. So I think what has to happen, I think what's already happening, which we've talked about, is that the regulators are now starting to see that there's a lot more data available now. As the transition becomes more mature, we've got a lot more data about plug-in hybrids that are 5 times more emitting than the laboratory says. So these facts are known. This report says it. This webinar says it. It's out there. Regulators hopefully be listening to this or can download it. And so therefore, what I think we'll start to see is that the assumptions will get standardized, the variables will get standardized. It'll be more and more difficult to game the system, to sort of massage the data in the various ways that that chart shows. And so I think we're definitely headed to a world in which if we stick with that protocol, as I think we should, that framework will get tighter and tighter with more real world data as the transition. And as we said before, you can't get away with reporting and pledges in the future. It's going to have to be actual measured, observed performance. And I would see, certainly in Europe, that's going to happen quite quickly over the next couple of years because this data is just from a lot of good work that Ben and others have done. It's just becoming, there's so much of it now that it's very difficult for regulators to avoid it starting to impose that onto the new system. So I think it's a good system. In theory, it's been kind of, in practice, not been the best, but I'm hoping it evolves, and I think we should stick with that because it's, as we've been saying, it's a good measure of, if it genuinely, the reporting and the assessment is valid, you'll start to see a divergence like that signpost you showed, Ben, which is those companies which are trying to stick with massaging accounting standards and those that are genuinely investing in the alternative vehicles.
If I can supplement something or an additional thought on what Harry was saying, I think there's also a reckoning, at least for some companies, that there are very, very clear and present dangers. I mean, we know we like to talk about climate risk, transition risk, et cetera, but a lot of that sounds a little bit academic to a lot of people. But I think there's a lot of companies out there who are realizing that risk, that they have to take action, and that also kind of will reflect on their reporting. So I think reporting will move from a tick the box exercise, kind of like I don't really want to do it, but I'll do it, to something which is kind of like we really have to, because we do need to think about the longevity of our business, and so take into much more consideration the various climate risks, the physical risks, litigation risk, transition risk, etc.
I mean, just to add one comment on that as well, it's a good point. I think Ben said earlier about lobbying investment as a proxy for, kind of a strategic, focus on transition. I would think we might, again, what Joseph sort of saying, you might turn this whole thing around and say that emissions are becoming less of the kind of target and the policy targets, etc. They're becoming a measure of whether you're transitioning or not. I mean, hybrids, as far as I know, every single hybrid today manufactured has a tailpipe, and that's a big tell as well, if you want observable measurement.
Yeah, thanks both. And thinking about sort of carbon accounting and staying with that point, I'd like to bring Ben back into the conversation. So, as I mentioned, Toyota recently joined Carbon Measures. This is an Exxon Mobil-backed coalition advancing e-ledgers to eliminate sort of double counting. So Ben, what's your view on Carbon Measures, and does this ledger transition represent a step forward in digital traceability of emissions, or is it more of a defensive effort to shift use phase liabilities off OEM balance sheets?
I mean, fundamentally, I think it's certainly more of a defensive effort here. And I think, moreover, it raises major questions for investors around the quality of this emissions data going forward. Right now, Scope 3 really does provide valuable insight into the climate footprint associated with a company's core business decisions. And at the same time, like Harry mentioned earlier, lots of governments globally are attempting to translate what's currently a voluntary GHG protocol standards into reporting greenhouse gas emissions into law. Particularly in the EU, we're seeing this as well as in other jurisdictions. And so while e-ledgers may have some value in sort of calculating product level emissions for some very niche policies like border adjustment mechanisms, this isn't across the board. And the real risk of that is that there's a play here to essentially replace Scope 3 emissions accounting, which would have major negative repercussions as, again, they often reflect the main and most direct consequence of a company's business model decisions. And again, ignoring a company's responsibility to reduce these scope 3 emissions really prevents investors, regulators, and consumers from fully understanding and questioning what are essentially these highly emissions intensive business models. And I think really it's just very important to look at the context here and address some of the carbon measures members. So it's of note that Exxon's the largest investor-owned global CO2 emitter, and Toyota again has the largest scope 2 emissions according to this report. So you're looking at some companies that basically have the largest current or historical emissions and are pushing for a new strategy that would essentially de-emphasize the importance of scope 3 emissions, while globally across the board GHG emission standards are accepted by the vast majority of the business community to be the accepted sort of emissions reporting standards. So yes, it's certainly a real risk, and I think this defensive effort should be monitored by investors across the board.
Thanks, Ben. And just looking at the questions that have come in, and it's we talked already about some of the laggards in the industry, and there's a question here which is, what are your thoughts about Honda retrenching away from EVs when it seems they should accelerate their transition? So a question for the three of you, what's your thoughts on Honda specifically, and their sort of lack of ambition, I suppose, around the transition? Harry, would you like to start?
Yeah, I can give. I've sort of thought about this before. There's a general point about Japan Inc. Sort of retrenching into the whole strategy that they had of all of the above technologies, and there's still a couple of Japanese hydrogen fueled vehicles out there, I believe. So I think what's happening there is that um, that strategy is looking very expensive at the moment, or maybe a lot of. I think we talk about stranded assets and Carbon Tracker a lot, but I think in what the Stellantis episode tells us in the automotive industry is the specific way this could go wrong in the automotive industry is capital obsolescence, by which I mean you could invest a lot of money in hybrid technology and sort of not very good, not very believable EV technology if you're trying to spread your capital across, but actually still keep very close to ICE technology because it's your big earner, your big near-term earner, and therefore you become very poor at hybrid. Hybrids become maybe a bit of a bridge to nowhere. Your EV technology is kind of spread thin, not very good, and you end up saying, well, we better stick with ICE. And I think what Honda's possibly, I mean, it could even just become, very good at kind of lawnmower technology as to kind of, or motorbikes or whatever, and just retrench into that niche where it's more comfortable. And I think that's what you're going to see. So I think if the transition risk is, say, X for Toyota that we talked about a few minutes ago, I'd say with Honda, it's kind of 5X risk generally, but maybe they actually have given up at being actually a bona fide international car company. They're just going to become a niche player in this market. They seem to have retrenched into a corner which they might never get back out of. That's not an investment recommendation, by the way. It's just a thought.
I think another thing that we may probably see, I mean, I don't like to speculate on my fundamental analysts, but is a lot more M&A coming up with the internal combustion engine kind of specialists, but the Honda likes, because again, if you look at what the Chinese are doing on the EV side, what are Europeans and Japanese and later on the Americans going to do? So that could also be one one path, future path for these companies. But I absolutely agree with Harry. I think the stranded asset picture is pretty scary, and it's a very, very high risk.
I just also add both of those points. I think what we're seeing across the board is the Japanese auto industry is now competing with the Chinese automakers more than elsewhere. And there's a major chance with this retrenchment that they're just going to eat their lunch, essentially, especially in lots of emerging markets where we're seeing a massive uptake of electric vehicles far faster than was initially predicted.
You got a big leapfrog.
Yeah, thanks all. Just being aware of time, we've got about sort of 5 minutes left or so of this webinar. So I just wanted to ask just one more question to all the panelists before we look to close. So my final question for each of you is if there's one single metric or question that an investor should put to an automotive board to expose hidden carbon exposure, what should it be? So a question for the three of you.
I'll kick it off if you want. I'll do it very short till another time. I think that we've kind of touched on it already. I think the single simplest and observable and unavoidable to gain metric is BEV sales as a percentage of total sales, and maybe just throw in on top of that a little bit of and what's the trend in that, what's your strategy for it. But that's kind of an unavoidable one. The only other thing I would add on top of the question might be if all the emissions suddenly switch to real world numbers versus laboratory, how exposed would you be? And could you just give us some numbers on that? But that's the kind of question about strategy, if you like. But simple one, what shares of your sales today are BEVs, and what do you expect them to be in 2030? Kind of unavoidable, binary sort of answer.
Yeah, and I would say what I really look at is, the company's strategies over the next, 5 years or beyond, and where the capex is going. I mean, are they actually putting money where their mouth is, as opposed to just saying, oh, we want to be green and we're going to produce lots more EVs, et cetera, et cetera. What's the actual strategy, and what is the capex behind that strategy?
I'd probably agree with Harry in saying that BEV sales are the clearest metric. I'd combine that with lobbying data as well, because that's what we do well at InfluenceMap, but I think it's just the clearest metric possible.
Yep.
I think having the transparency on capex is really, really important for this transition. And oftentimes when you're looking at company accounts, company statements, it's not always clear where that capex is being spent, unfortunately. So there certainly needs to be more transparency there. And I think as well, if we're thinking about battery electric vehicles sales and the targets, there needs to be if you can have those intermediate milestones as well, both short and mid-term. But no, I think that's all actually. So thanks all for your answers. Really interesting panel discussion. Thanks all. We've only got a couple minutes left, so I'm going to hand back to Maureen to close out. But thank you so much to the panel.
Thank you,
Thank
Ben.
you.
And thanks from my side to all the panelists and you all for joining us today and for spending your time with us. As a next step, we'll be following up with some key takeaways from this session, sharing also the recording and the presentation used. And we would be happy to also discuss with any of you in more detail any of the findings and discuss how we can best support you through any engagement process with these automakers. So yeah, thank you again for your time and participation, and we look forward to continuing the discussion with you all. Have a nice rest of the day.
Thank you.
Thank you.
Thanks a lot.